This just happened. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story, a major bank is running out of cash and facing insolvency. And you may remember we mentioned that March could bring back the revival of the banking crisis. And sure enough, it's here as we see New York Community Bank stock outright crash as there are signs they're running out of money and desperate to get some. This could trigger, of course, another series of bank runs and expose a lot of other banks and kick off again as we're suggesting the next banking crisis. And speaking of bombshells, the Bureau of Labor Statistics dropped a big one today as data now suggests that the U.S. economy is nowhere near as strong as the political elites want us to believe and has serious repercussions for the high-flying equity market. Plus, we have a sponsor for today's show, Camber Energy, on the New York Stock Exchange under symbol CEI. They just announced a bunch of positive test results, and ahead of that, their stock saw a massive amount of buying. This is setting up a big opportunity to send their stock price higher as it's sitting right on top of their volume profile. And if those of you who are traders know, this is setting up a big move, what we think could be 52% return. You're not going to want to miss out on this one at all. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Wall Street Journal where we get this breaking news as New York Community Bank Corp seeks a cash infusion. This is dangerous when people start to realize their banks aren't safe. The bank runs will be back in a big way. We said that New York Community Bank would be likely the first one to lead this down. People came and started buying their stock, and now all of a sudden it's outright crashing further as it's buffeted by fears of potential real estate loan losses, weaknesses in its internal controls, and a sharp drop in stock price. This has dispatched bankers to gauge investors' interest, get this, in buying stock in the company. So here, as their stock price crashes, they'd rather just try to raise money by issuing more shares than going to the Fed. This is a dangerous move because what now investors are seeing is this bank has got serious problems, far worse than it is even willing to admit, and that means, of course, it's time to get out. And there's no guarantee there'll be a deal which will make this worse as depositors will start to scramble, or one that would succeed in addressing the bank's challenges, which as of this morning have led to roughly 70% decline in the stock price since January. And of course, this bank hasn't been in crisis mode since back in January, which has revealed signs of trouble in its commercial real estate books, saying it swung to a loss in the fourth quarter and slashed its dividend. And when you're an investor, there's nothing that gets you more excited about selling than when you see a stock you own outright plummeting. And the fact that they're going to go out and try to drum up cash by issuing shares is not giving anybody, not the depositors, not the investors, any vote of confidence here at all. In fact, last week, the bank disclosed it had found material weakness in the way it assesses and monitors loans. The disclosures have triggered several credit downgrades, as we noted on this show. And now the bank's woes have touched off concerns of another banking crisis. You know, we talked about that the banks are stuck in a position where they just don't have enough cash. They're not originating enough loans. We continue to see commercial industrial lending contracting on a year-over-year basis. We know that the Fed has the yield curves and money curves inverted. This is constricting the creation of credit. Now, in a debt-based economy, what this means is like a game of musical chairs. At some point, someone who needs money, well, they can't get it. And the worst person this could happen to, the worst sector, is the banking sector. And of course, New York Community Bank now at the forefront of this after 3 regional lenders collapsed roughly a year ago. And we said again, March could bring this back. And sure enough, you can see this is, as of today, their stock price outright trembling during intraday trading today as confidence in New York Community Bank is completely lost. Everybody wants out. No one wants the stock. And now what we're seeing of particular concern to investors is its concentration in loans for rent-stabilized buildings in New York. In fact, that market has struggled with rising interest rates and the aftermath of a 2019 law that capped how much landlords can increase rent on some units. Roughly half of New York Community Bank's portfolio of loans just happens to be in multifamily residential properties subject to rent regulations, meaning they can't raise their prices. So of course that means whoever's holding these loans, which is New York Community Bank, is going to have trouble refining them because rates have gone higher. Of course, those who are actually making the payments, they don't have the money to do it. That's the challenge. Now, many people believe that what's happening in New York Community Bank is a one-off issue. What we're saying is this is just the beginning of what will be more banks heading down into an abyss, as New York Community Bank has sought to reinsure investors over the past month, overhauling its management, saying in early February that its deposits are secure. The only question now remains is what other news will we find out? Will depositors keep their money there based on this news, based on the plunging stock price? A year ago, when we saw banks' stock price start to crash and depositor says, you know what, I'm not taking any chances. If that starts to happen, if we see another bank run here, it's just a matter of how quickly New York Community Bank hits insolvency. And of course, that means someone will come in and have to buy it with some luck. And here we can see they laid out a series of options that the bank could explore to bolster its balance sheet, including selling assets from certain non-core businesses. The bank also considered turning to newfangled financial instruments that would share the risks of those loans with outside investors. But finding takers for those assets, or at least at prices that would make a deal worthwhile, have been challenging because higher interest rates have brought asset prices down. And this is, again, we talk about when the banks start to fail here, the Fed will have no choice but to cut, because the banks are going to go to the Fed and say, look, we don't want to just borrow money from you. We want to get ourselves back in a strong position. We'd like to sell some of these assets, but just so happens we're upside down on them because you inverted the yield curve. Fed will have pressure to put rates back at zero in a blink of an eye. Just wait and see, and it won't be good news when it happens. And this has been a problem now for New York Community Bank and will be a problem for other banks, as U.S. officials have expressed reservations with banks pursuing credit risk transfers that would shift the burden of potential losses to entities outside the regulated banking system, suggesting that regulators never did and still do not have an answer for what's going on in the small and regional banking system. And this is going to lead to the next banking crisis, which will be followed by an all-out financial crisis, as you'll see, will spread through all of the world. And one of the challenges we continue to hear is how strong the U.S. economy is, how strong the labor market is. Well, as you're about to see, that's all starting to change, and it doesn't bode well for the U.S. equity market. But let's talk about the good news first, because U.S. companies added 140,000, at least according to ADP. This in February. We get the official data from the federal government this Friday, so hang tight on that, because ADP is notoriously, well, they've been wrong. In fact, all wrong to the wrong side. Usually they underestimate the actual payrolls, which suggests, of course, the Friday payroll numbers will be higher than most people expect. We'll find out then, as pirate payrolls, as I said, increased by 140,000 last month after an 11,000 gain in January, suggesting the U.S. labor market is gaining strength, and that should mean that wage growth is picking up, and sure enough, it did for those who changed jobs, which marked the first acceleration since November of 2022. But for workers who stayed in their job, wages advanced at their slowest pace since August of 2021. And that's not good news, because indeed, if the economy here was booming, that those staying in their job would actually be getting higher wage growth. They're not seeing that. The question comes is, are they getting the hours that they need, or is that being cut back too? Because what we noted in the numbers from last month is hours worked got outright slashed. And that, again, none of this seems to be a good sign for the equity markets. As you're about to see here, as we look at the Wilshire 5000, now this is shown in blue as the total U.S. equity market. This against total compensation, which is shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That in red on a year-over-year rate of change. And what's notable here is that you tend to see slowdowns and decelerations in total compensation lead us into recessions and, of course, bear markets, as shown here as, of course, the Wilshire 5000 follows total compensation growth lower. We see that happen going into the global financial crisis. We see it again impact stocks during, of course, what looked like a globally synchronized recession that got saved at the last minute. And now you see compensation growth just outright crashing at a time when everybody is buying into U.S. equities in a big way, suggesting at some point those jaws, what you see there, they must close. And that means either we see compensation growth needs to surge higher. We'll find out more on Friday or at some point, there's going to be a big reversal in equity prices, and that doesn't look good for, of course, banks like New York Community. As job gains remain solid, this from the chief economist at ADP, as pay gains are trending lower, not a good sign, but are still above inflation. And notably, one thing they don't mention is hours worked, which is critical because you can give people a raise, but if you cut their hours, well, that means their paycheck still can shrink. And one thing this also doesn't tell us is the cost of debt service. We know that consumers, maybe that's fact that their wages in terms of hourly earnings are keeping up with inflation, but their debt services costs are going up in a big way. They've had to take on a lot of debt to get through. Of course, what we saw was that slowdown as wages did not keep up with inflation. These reports just don't give us the truth of what's really happening out there for the average consumer. They did note job creation was broad-based, led by leisure and hospitality. Notably, those are low-paying jobs, construction, trade, and transportation, and those gains were well spread across regions and business sizes. But now, while the ADP gave us some good news, which could lead us to potentially bigger news from the non-farm payroll report on Friday, of course, not that that will matter too much, but we know the market loves that report. One report that's changing everything about how we now see the labor market, that is the job openings and labor turnover survey. Here we have our zero hedge as they note the job openings and hires slide as workers quitting their job plunge to pre-COVID levels. This is not good news. After declines in U.S. job openings accelerated in the last few months of 2023, prompting economists to pat themselves on the back for predicting a soft landing and validating their expectations for Fed rate cuts, only to see the trend reverse dramatically last month when job openings unexpectedly surged back over 9 million. Moments ago, the BLS came out with its latest January data, which showed another mixed report, which revealed that January job openings dipped modestly from a downwardly revised December print, but came right on top of expectations. Now, one of the challenges here is you expect where job openings go, as we'll show you, the U.S. equity market follows. And what this translated to now is the number of job openings dropped 42,000 in January to 8.863 million. And this is not a good trend at all. In fact, it suggests that things for the U.S. economy are far worse than many people want to admit right now. Here again, you see the Wilshire 5000 price index against now the JOLT survey, total non-farm in red. And what do we know? Of course, where job openings go, the U.S. stock market tends to follow. You see that very clearly here going to the global financial crisis. You see it even going into the pandemic as we're headed into a global recession. Stocks eventually reverted down as the jaws did eventually close. You see that happening here again during 2014 through 2016. And now you notice, again, the equity market grinding higher as everyone believes that if companies continue to lay off people, this is great for their margins and great for earnings. They're starting to realize, at least they haven't quite yet, that this is not good news. It's only a matter of now quarters ahead before we find out that cutting heads didn't work. What that means is demand continues to fall. The labor market is suggesting that. And as we can see on this chart, something's got to change. Either job openings go up, which we're not seeing, which is abnormal when the equity market rallies, or stocks need to come down. And speaking of revisions, just like in the payroll report, here too the BLS appears to be tasked with making it great. If erroneous first impression, then quietly revising it lower. And sure enough, 6 out of the 8 past months have seen job openings revised lower, a trend we continue to actually see across many of the data series put out by the government lately. They give us a wonderful headline number that people get excited about, and then quietly over the months that follows, when no one really cares as much, they just revise them down and revise them down. Not, again, a good sign of the economy. And no matter what the data shows, let's not forget it's all estimated, and it's safe to say that the real number of job openings remains still far lower, since half of it, or some 70% to be specific, is guesswork. And we'll show you why. Of course, the job opening situation is indeed worse. The BLS admits the response rate to most of its surveys have collapsed in recent years, and the JOLTS report being the worst of all, as actual response rate remains near a record low of 33%. We'll show you what the real numbers probably should look like. Here you can see job openings against total compensation. Of course, it makes perfect sense if employers are cutting hours here, and despite the fact that they may be giving out raises, they're not not going to go out and hire. So you can kind of just get the perspective. An employer's not going to come in and say, look, we're cutting everyone's hours. And oh, by the way, we hired a bunch of people over here to fill in that gap of hours. It doesn't make any sense. And so what we continue to see now is that average hourly earnings tend to lead in terms of total compensation growth where the job openings data goes. If that's true, which we'll get, of course, revised numbers on Friday, notably the question being is, did this big collapse in hours work stick? Or was it a one-off bump? We don't know. If that's the case, then job openings are about to outright plummet below. That will again cause pandemonium in the markets, as it suggests that the U.S. economy is nowhere near as strong as the equity markets and the political elites believe. And we have further evidence of that as we look at a major retailer, Target, as they jump as better inventory management now fuels profitability. Again, the market loves stuff like this. But what is missing is Target has struggled with declining sales as consumers purchase fewer discretionary products as higher inflation and interest rates eroding purchase power, which has shifted, has prompted Target and other retailers to sell products on markdowns, hurting profits. But again, the market doesn't care about that, at least not now. At some point, it's going to care in a big way. We know demand continues to fall. We can see it all around the world as DHL owner Deutsche Post expects limited earnings growth this year. Why is that? Well, broad economic upturn in the first half of 2024. Well, DHL has not seen it. They expect volumes to decline further in some markets before global economic momentum picks up in the second half of the year, which at this point is all based on hope. There's absolutely no evidence that the economy is going to pick up the second half of the year. Many believe it'll be on the back of a couple central bank rate cuts. The reality is those will be too little and far too late. The year 2023 was characterized by a weak global economy and, above all, weak global trade. Major uncertainty factors such as volatility in demand and geopolitical crises will remain with us in 2024 until labor markets around the world go, which we're seeing the beginning of. We started to see data in Germany. We're seeing some signs here in the U.S. We'll get, of course, on Thursday, the unemployment claims data. Friday, we'll get the non-farms payroll report. In the meantime, Powell stands before Congress as well. There's really nothing I can do because he reiterates the Fed needs more confidence on inflation to cut. Can't see that all of this data suggests the U.S. economy is not headed in the right path at all. In fact, he noted that the committee does not expect it to be appropriate to reduce the target range until it has gained greater confidence that inflation has moved sustainably towards 2%. But one thing we do believe has got a massive amount of upside potential, and that is the stock for our sponsor today, Camber Energy. You can find them on the New York Stock Exchange under symbol CEI. Again, we're going to show you a setup. We see their stock potentially surge by as much as 52%. Let's talk about who Camber is. You can find them, all the information in the links in the description and pinned comment below. And they just recently closed a merger with Viking Energy. This happened last year. Is now actually doing business under CEI for the first time since 2019. And they're employed a diversified growth strategy focused on industry-changing technologies such as waste treatment using ozone, open conductor detection systems, and this is going to be a big one, license of carbon capture systems, because one thing we know is that governments around the world are putting in place new regulations to deal with carbon credits, and all this is going to do is lead to big business for companies like Camber Energy. In fact, that merger was big for them because the revenues for the 9-month period ending in September 30th were now $24.4 million compared to where it was in the 9-month period ending in September 2022. And stockholder equity now, as of September 30th last year, $29.2 million, setting up a potential big move in their stock based on this announcement alone. As you can see, Camber Energy shares positive test results of patented carbon capture water removal system. Now, one thing I want to prepare you for is a lot of people were buying the stock ahead of this. They had great confidence in this test, and sure enough, it delivered. In fact, you can see initial results of ESG's patented water removal system exceeded a water removal rate of over 90%, reaching this level of efficiency in removing water from emissions associated with power generation enables the lowest cost and most energy efficient way of capturing carbon, this according to technical specialists at ESG. And they're planning to keep working with their benefit as they scale to meet the demands of fossil fuel consumption in small and large power facilities, and eventually the transportation industry as they look to further optimize the process and integrate it with other elements inside their proprietary system. And here you can see that this testing took place recently at ESG's 4 megawatt power generation site, and using calibrated humidity sensors positioned at both the beginning and the end of the exhaust stream, the results exceeded the model forecast of 83%, which was developed during the initial design phase of its carbon capture product. And this is going to capture the attention of investors. What we believe it's got a catalyst to send their stock up as much as 52%. Check them out on the New York Stock Exchange, CEI. Let's talk about how it works here, because this patented system consists of an advanced ceramic membrane that has been incorporated into a unique mechanical cooling system that can remove the water vapor before it's treated for capturing CO2. And ESG Clean Energy plans to implement this technology across all of its plant facilities. And here's the big part, is license this technology to a subsidiary of Camber Energy for all of Canada and multiple locations in the United States. And this is setting up a potential big move. Ahead of that press release, of course, we noticed there was an increase in buying of the stock as those who knew this test was coming believed in its results. Here you can see the 6-month volume profile. This is the average price over the last 6 months that people have paid and traded at the most of the shares. That's 23 cents. And you can see as of right now, the stock price is sitting right on top of that, which means the buyers are starting to overwhelm sellers, and that means it sends up the next move into the supply zone above at 35 cents becomes the next target. That would be a 52% move. And here you can see, looking over the last 90 days, buyers were indeed all over the stock at around 16%, working out the sellers as they knew that this test was likely to come back when positive results. It did, it exceeded them, and all of a sudden the stock price started to rally. And here we can see a consolidation as we look at the last 10 days, as the sellers are still getting worked out here, but the buyers are taking control. You can see it pushing out over the last 10 days here above the volume profile line, looking to take the stock even higher. And again, you can find Camber Energy on the New York Stock Exchange under symbol CEI. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.